How's it going, everyone? I am here today with a very, very special guest. We're going to be talking about quantitative trading, but in the world of hedge funds. I'm here with Dylan Johnson. How are you doing today? I'm so excited you could join me.
Good. How you doing?
I'm having a phenomenal day, always craziness in the market. And I think we're going to get into a very interesting conversation of how someone in your particular seat actually not only views what's happening in the market, but almost views the structure as a whole. And really to get a little bit more philosophical on you of just like how you approach trading. So for everyone listening, for all the audience members, can you explain kind of what you do, who you are, and even kind of like more of how you got here?
Of course. I've been in the hedge fund industry since 2014, and I actually was involved in launching one of two friends of mine at the time out of college. My work was the predominant strategy that ran the fund. And when you're coming out of school and you're getting into this industry from the ground up, and you learn a lot along the way, and your career develops from scratch. It's a learning experience to say the least. But I would say that my background is largely self-educated through a lot of reading and analysis and working with data. It's in applied digital and statistical signal processing techniques that I have gravitated over the years towards viewing those techniques as being the most fundamentally viable techniques to make trading decisions around.
Now,
And
is
a
that
lot of
what,
my
sorry to interrupt you there. Is this actually what you studied in college? Because that's where you said you mentioned you
Yes,
like
it
met
is.
people. That's
I
okay.
did. I went to school for economics
Okay.
and finance, but I was able to get about one third of my credits as independent studies, where I studied fields and
Wow.
waves, digital signal processing, statistical signal processing, and time series analysis. And being able to do that through a self-directed study program with the faculty was extremely advantageous to me for my ambitions to get to where I'm at today.
Wow. Now, is that something that you were able to do with a bachelor's? Did you go into like a master's, a PhD? Because like me, I have a STEM background, but still, that sounds like pretty impressive there.
Yeah, no, I didn't pursue more education. I actually went right into the industry out of college. I was pretty eager to get in there and actually build and apply models, which I had built at the time, to gain real world experience.
No,
I think that's what's going to teach people way more than a theoretical academic perspective when dealing with a complicated engineering problem, which is trying to time the market and or trade and manage risk around the time series that you're viewing on your screen.
how did like my mind is already being blown because how did you even know that so early on? Like I was always interested, for example, in stocks, and I was like, oh, like I try to buy low, sell high, but it sounds like you approached that early in college. So there you are at 18, 19, 20, 21, like kind of already knowing you're going that path. Like, did you have like a parent, a grandparent, a mentor who's like, hey, like kind of going on this path? Like, I'm just curious how like this world even got opened up to you, if you will.
Not really. I had a high school math teacher who was a very successful investor, and he was actually a very rich guy. He just taught for fun, to be honest, from speculating on gold futures his entire life.
Mm.
But he kind of got me interested at 14, and that's whenever I started reading a lot of the traditional books on fundamental and technical analysis, like Edwards and McGee, and The Intelligent Investor. I read those at 14 and 15 years old, and like around 15, I read High Powered Investing for Dummies, just Turtle Trader. It's very typical books at a younger age. It just kind of compounded itself. So I had completed the CMT Level One program at 18, and
Oh, wow.
I became very disenchanted of technical analysis quickly because of its subjective, material.
Mhm.
Around 18, 19, I gravitated towards more model building through Perry Kaufman's work. New trading systems and methods was kind of the Bible for me at a young age. And I just geometrically learned and read everything I possibly could while I was in school. And that's when I started building models. I was about 18, 19 years old. Simple stuff like ADX scanning on TradeStation,
Mhm.
on balance volume crossing its own exponential moving average, stuff that I laugh about now, but still has effectiveness and is really
Mhm.
good to learn. So that's kind of how I got into it. And whenever you try to, the best way I can explain to people is you need to know what you're looking at. When you can identify what you're looking at and you can define it, you can then reverse engineer it and build solutions towards it. And that's basically what the market is. It's an engineering problem whenever you're coming from a hedging, trading, or risk management perspective. I title the market as a continuous stochastic transverse waveform because that's what it is. And when you understand what it is, you can take it apart and understand ways that are effective to analyze it. So we know that markets exhibit mean reversion. We know markets exhibit trend. We just don't know when it's going to be each one. So you can build viable strategies for each market regime, but knowing whenever to implement and how to make them actually work in the real world with real money is a whole different topic and a whole different ballgame of expertise.
Now,
So
let's just say for like a second, theoretically, let's just assume you have double the intellect I do, and I don't know what an abracadabra waveform is. Could you explain that to me in a little bit more of layman's terms of like how you're viewing the market?
it experiences random movement with different regimes, and because of that, you can't be sure of what it's going to do in the future. But we do know it operates as a waveform that propagates with randomness, meaning it has directional movement. We just don't know how long it's going to exhibit what amplitude or duration of that movement. So that's where it becomes a engineering problem.
So at that point, then, are you looking at the odds of these situations of like, okay, this is more of like the way I was always taught about systematic trading is two forms. You have mean reversion and you have trend following. So are you almost looking for, let's just say, super basic example, the deck to get stacked in your favor, and then that's when you're putting your money on the table? You're like, okay, we think that there's like a statistical likelihood of whatever XYZ happening, and the higher it is, the more money you'll bet, yada, yada, yada.
That's a component of it for sure.
Okay.
And there's also a component of just trading what you're in. And you can allocate out, capital, like you said, to different situations, which I do. But I think more of it is understanding what you're looking at.
Gotcha.
And really what the market is a gigantic statistical noise issue. And you're really trying to figure out where you're at and where it's going with a relative degree of certainty. In order to do that, you have to implement, which I believe are a lot of complicated mathematical formulae that operate in a very simple manner. And that's
Gotcha.
pretty much a fancy way of saying you need some very complex math to operate very simply to have effective results driven trades.
I like that. So you're developing this framework in college. You're feeling more confident about it. You end up graduating, and obviously it seems like you wanted to get more so into the world of Wall Street trading, money management, obviously running a fund. Tell us about that. You graduate, you get your cap and gown, and you know you want to start dealing with money on the market.
I wouldn't recommend my path to most people. First of all, I came out of college and launched a fund. We had a blockbuster first year. We were in the top 2% of performing long short equity funds received the HFRI Constituent Award. We were up after fees about 8.5%. The market was negative like 17 basis points.
Oh, wow. And this is you at like 22.
23.
Wow. Yeah. I mean, talk about, did you like did you feel like king of the world, like top of Mount Olympus there?
I was relatively well grounded, but there was definitely an air of like over optimism because the next year it really bad. Actually, we were down like 16%.
Okay.
Because the strategy I was running was a momentum strategy, right? A fairly complex one calculation wise, but operating very simply. And the following year in 2016, you had the legendary volatility drought in the S&P 500. We actually haven't seen one that bad ever since then. So naturally, I didn't do as well and had a loss. And, one of the events that we went in was we had a short momentum signal, and I was managing like 8 or 9 million at the time. And we were trading basically the sector ETFs like XLE, SPY, all those individual ones. And I went and borrowed 2-to-1 margin. So I'm basically like $20 million short the S&P. And that morning, you have the Mario Draghi will do whatever it takes bazooka right in my face. Soul crippling $1 million hit in a day.
Oh.
Back. So, when you're 23 years old and you're managing millions for people
Mm-hmm.
and you've never been at a real trade desk, you kind of invented your own because you're running a hedge fund at 23 and you had a blockbuster year and now you're getting pounded. It makes you grow up very quickly because there's no, mentors, there's nobody to hold your hand. You're the one who makes the decision. You're the one who wins and loses. And I think that that's a very important part of this business is losing. I don't respect traders that don't lose or haven't lost. No, because they will eventually lose. And how they can handle that psychologically and running the business, not even from the trading decisions, is what determines the fate of the company.
Man.
So if you end up launching a fund of weak stomached people, If they have a bad year or a drawdown, they'll probably want to get out of it or get scared and the business will collapse. You cannot have partners or employees or guys you work with who are weak, psychologically worried about their reputation, worried about how they look to other people. They need to go sell insurance or be financial advisors. They have no business in managing money.
I mean, I think it's a brutal take, but it seems like it's a very honest take because it is. I mean, we've all been in the situations of even in our like relatively small personal accounts, those swings are gutting. And then all of a sudden when you're throwing in the fact that you know it's other people's money, a lot of the times, I don't know if it's true for you, but when people start their first fund, a lot of times it's your family's money. So I would assume the emotional toll like has to get really, really brutal there. So coming back to your story, you get out of college, you crush it the first year, second year, not so ideal. What's going on? How's that year end? At one point you were leveraged up to 20 million. Where are we going from there?
So we ended the year down about 16%. Okay. And at that point, me and some guys, went our separate ways. I went the one way of the founder and myself. He was instrumental to being launched. Great guy. The other guys were good guys, but they just weren't meant for the business. Mm-hmm. So we basically said, hey, we're going to go our separate ways. I wanted to go into the futures trading route instead of trading the S&P sectors for many different reasons, but it's cheaper, higher rate of return. It's just better to trade futures than in ETFs. Mm-hmm. Big kids trade futures. Everybody else trades nothing. I mean, you can be a great stock trader. That's cool. But whenever you can trade energy futures or S&P futures, you have unlimited scalability. Mm-hmm. You can manage billions and not move the market. And that's the direction you want to go if you want to be a big boy in the industry. So I said, okay, how do I do this? I met a guy from Goldman Sachs who was a big time energy trader, worked at Jay Aaron's desk, worked at many different hedge funds, made a lot of money, very successful, knew a lot of people in the industry. So I started prop trading with them and started building models more geared to trading commodities. But I wanted to be sure before I did anything. So I spent about 4 or 5 years gaining that experience, cultivating it, building models, trying to get things on in development to actually make an all-weather set of signals and strategies. And when I finally felt comfortable with that, I was able to network with the right people. Took us a year to get a fund set up, and we have just launched. So that's just kind of my story and my background.
Man, that's so cool. Out of my own curiosity, when you're getting it, not only from a money standpoint, and like I know right now, the past year, the economy's been a little rocky. So is capital drying up from maybe even a legal perspective? Is it tough to like legally structure one? Like what are some of the major hurdles that you were like, it was really difficult to overcome, especially if you weren't expecting them? I
would say the biggest problem to deal with in this industry is going to be raising money. Raising money is difficult because it costs money to raise money. And if you don't have somebody who can cash flow the business, and I mean substantial cash flow, you need to have someone who has deep enough pockets to carry it for years. And you're looking at minimum $500,000 a year between salary, paying the bills, operation expenses, marketing expenses, the whole 9 yards to do it.
Oh, okay.
You don't want to earn $500,000 a year arbitrarily. 4 years, you know what I mean? Yeah. Some people don't care, some do. But you got to find somebody who can throw $2 million and just burn, and then have $500,000 or $1 million to trade and not care. That's probably the hardest part is finding that guy to bankroll you if it isn't your own money to get in the world of hedge funds and start building it.
Now, maybe it's just the timing's different, or who knows, for all I know, maybe it's just like interest rates. But when I was reading these biographies of people such as, I don't know, from Pearson Square, like if we're talking about like Ackman, Dalio, Cohen, it seems like they all have kind of like humble beginnings. Like I started with this. Like has something in the industry just like pivoted, or just is it back then things were like cheaper to get going?
I come from a coal town on the border of West Virginia. Okay. My dad was a power plant maintenance mechanic. So, I mean, I came from very limited capital and money, and people are hungry to sell in this business. People are smart to excel in this business. If you have both, you're going to make it, and you need to have both.
So coming back to this fact that you like commodities, and you're bringing up a lot of reasons. One of the things that I talk to other retail people about, the thing that, and this is for definitely small people, but I still love it as retailers, there's no pattern day trading. The amount of stories I hear of that just like tripping people up and their account gets frozen for whatever 90 days, no more trading. But folks, if you're listening to this right now, you can trade futures. And granted, you probably should have more than 25K just because of margins, blah, blah, blah. But my point is there's no pattern day trading. If you want to go in and out for 1 point all day long, you can have at it. And that's just the function of how this market really works.
You should, if you're going to trade futures, I recommend a $30,000 account balance to start, and you would trade the micros. If you want to trade the minis, you need to have probably 70 to 100,000 to be safe.
I appreciate that. Yeah, no, that's a common question. So like right now, and I don't know if my audience knows this, but just to share with you, I'm trading Treasury right now, and that's what it is. 1 micro on NQ, 1 micro on NS or ES, excuse me. And that's the S&P 500, that's the NASDAQ, and you could just size it down. And obviously from there, it's just a tenth of the size. So folks, I'll leave some references in the description of this video if you just want to see what it's like and the sizing and all that. But it's a beast of its own. Like there are similarities with the equities market. There are similarities with the options market, especially in terms of terminology. But then there's a lot of things that you can only find in the futures market. There are aspects of the futures market that it's just there and it doesn't really exist elsewhere.
A great point is extremely liquid, extremely scalable for track record, and it's open 23 hours a day during the week. So you have the ability to make money whenever you need to, and you have the ability to not have to worry about liquidity problems.
Yep.
I mean, you have a stock, and you buy a whole bunch of it, and some earnings announcement happens the next day, you're down, there's something you can do about it. With futures, you don't have that problem as much. There's a little bit of an over the weekend risk, but I mean, there's more accepted levels and ranges that I think in trading individual futures can help with beginners in risk management if they trade small. Crude oil isn't going to go down $20 in a day very often.
Yep.
Probably never, but I mean, you're not dealing with a lot of like gap risk of futures as opposed to individual equities. Individual equities are expensive to trade.
Yep.
I mean, it's cheap to trade futures, especially energy futures. That's why I love it.
So is that specifically what you trade? Like right now, are you mainly trading oil? Are you in the world of natural gas? Like if you were after this call, before this call, what were the main things that you're trading?
IMEX crude predominantly.
Okay, so you're just following. Now, are you looking at it? So I get a little confused myself because like I'll be looking at oil and I'm paying attention to it, but it does seem like sometimes there's binary events of like, what is OPEC doing? What is OPEC not doing? It seems like there's almost geopolitical risk. Is that something that like sometimes you just get burned, or are you attempting to model that? Or is that something that every single day you're doing your best personally to predict what's going on in the geopolitical scene?
A little secret to looking at data is everything gets discounted in price, especially beforehand. Oh, wow. So it's something's going to make it move no matter what it is. Could be a news event, could be an OPEC decision, could be a really bullish or bearish EIA number. It doesn't matter. I don't care. There will be events that start happening in the time series quietly, like the preceding events before a large avalanche, like small snow tumbling, that will end up leading to huge volatility expansion. So I don't know what it's going to be that makes it move, and I don't care.
Interesting. Now, do you feel that indifferent about like really any market? Would you feel that way about gold, about sugar, which has been ripping recently, things like that?
Individual stocks to likes and shares as data points on social media.
Interesting. So to you, it's just whatever. I am like, so you sit down at the computer and you're looking at, well, of course it's a mathematical problem, but you're not really in the game then of like fundamental prediction. You don't care who the next president is. You don't care the next law that is signed or isn't signed. You are literally looking at some sort of mathematical event and or pattern to happen. And then that's a trigger for you.
Yep.
Interesting. Now with that, I'm sure within this, you've probably met a lot of people who are trading by their gut. They just have a feeling. You've probably talked to people who are just like hardcore fundamental analysis, almost like Warren Buffett types. Now, with it, do you think they all have their place in time, or do you actually think that your way of viewing the market is the best way of viewing the market?
I'm going to have a very unpopular opinion, but if you have 2 million samples, one of them is going to be this outrageous outlier, right?
Okay.
There's somebody out there that probably has almost never lost a trade just by the sheer amount of people that have traded.
I've never thought about that, but I agree.
So then Warren Buffett and different mega traders are just products of a large system, the entropy of it. So that's how I view them. They're like the 1 in a million type of organism that's going to happen to somebody, and they just happen to get lucky.
Yeah, it was them, right place, right time, right
What's
connections.
Warren Buffett is that okay? He was this one guy who happened to really create factor investing through fundamental analysis and value way before everybody else.
Mhm.
So let's look at Warren Buffett's returns now to Warren Buffett's returns in 1957. It's a form of arbitrage. So
Gotcha.
he's being arbitraged out slowly, in my opinion. Let's look at Two Sigma Citadel's returns in 1995, compare them to now. I mean, the trend's down. Okay.
Gotcha.
But then you look at a real engineering firm like Renaissance Technologies,
Mhm.
they're going up. Or Citadel's returns lately have been so big because we know that they kind of control order flow, so their guys can piggyback off that. So yeah, they did knock out the park, but like their main quantitative strategies get harder and harder to produce results of more money because other people figure it out, right?
They find an edge, and if you're the first one to it, it's just a race to like who's exploiting the edge.
Arbitrage exists in everything except for taking risk. Like my work doesn't get arbitraged out because I like directional movement and I like to take risk.
Mhm. So
So unless you can eliminate markets that move and directional movement, my strategy will never get arbitraged out.
okay, I think I follow that. Now, this type of thing, you brought up Renaissance. For those of you listening who maybe you haven't heard of them, it is probably one of the most well-known quant trading funds out there. It's started by a mathematician, and the returns are something that people just don't understand. They're jaw-droppingly good. So people like them, you mentioned Two Sigma. I think there's D.E. Shaw, AQR. I believe these are all quant firms. Now, to you, like, is it kind of all the same technique, or is the things that they're looking at and their vantage point of the market, or do they wildly differ, or are you guys kind of all roughly in the same ballpark?
Well, I mean, I would say that their methodologies of looking at everything is markedly different than mine.
Okay.
Their argument would be that ours is mathematical, time tested, and true. They don't like what they can't make sense of from a relatively valid mathematical perspective. Even if it isn't sound, they don't care. If it is valid enough, they look at it. I like a lot of theoretical wild stuff. So what people would say would absolutely not work, I'm going to see if it does, and I'll spend 7 months on it. And lo and
Sure.
behold, stuff that people say won't work will work. You just have to be willing to be laughed at and do the due diligence.
I like that. So talking about working and not working, could you just shed a little light of maybe a couple war stories of things where you're like, hey, I felt super good about it. I put money on the table and you knocked it out of the park. And then maybe if it's not too painful, maybe the opposite there. Were there times where you're like, I'm feeling really good, and then unfortunately it just went bust on you?
I mean, I would love to really try and indulge in those stories, but for the most part, I have a signal based approach. So
Mhm.
what I could say there are certain time series regimes that are particularly brutal, like in crude oil, Q3 of 2019, terrible. Um, First quarter of this year was absolutely terrible for trading crude, unless you're just trading a very tight range. So certain situations, depending what work you're running, that can be particularly brutal. But there are situations for other people who, like mean reversion, got absolutely decimated in COVID, right? In 2020, crude oil pretty much went from $70 a barrel to negative in a
Yeah.
6 month line. So I mean, I would say the worst time I ever got hammered was the Draghi Bazooka trade. Probably the one of the best trades I ever had would have been whenever I was net short the S&P for about 20 million in August of 2015, and we had the China devaluation crisis, and I absolutely just obliterated it in 3 days. Made a ton of money.
So
So that
the
was actually pretty cool.
but the whole time that's happening, you're not hitting buy or sell, right? Like you created the code and the methodology for it, but like it is literally your trading robot that's doing the buying and selling for you, right? Like you're just sitting there and watching it.
Yeah, so the only time I get involved is I make so much money, I'll just take a big chunk of it off the table.
Okay.
It's just like dumb to not to at a certain point because you have to be statistically reasonable. It's like if I just made 20%, which I did in 3 days on my fund,
Mhm.
did I not take a big chunk of those profits off the table? What's the probability of me making 50?
Yeah.
Right? It's dumb at a certain point. So there is like a hard risk management component that's in the strategy over that too.
Mm.
But for the most part, yes. I don't really make any trades without a signal deciding what I should do.
Man, I'm just sitting here with like a little smirk on my face because I imagine that there's been a time where you go to bed and, like you said, futures trade on the Globex session, which means it's trading 23 hours out of the day. And you wake up, and I'm sure there's times that you've woken up and you're up 5 figures, 6 figures while you're sleeping. Like conceptually, that's crazy because I think so much of retail thinks of this as I need to sit here from 9:30 to 4 every single day, and I need to watch every single minute bar, and I need to YOLO trade zero DTE options.
It's like a baby.
That's wild. And sometimes you wait, and I'm sure other times you've woken up and you're like, oh, that could have been better. But like just this concept of it's doing the work for you exactly as you want it to, and you're talking about like passive income, and it's not really passive. I use that term loosely.
I have woken up to being down and up millions of dollars. And I've
What? That's so. And you're just sitting there like casually eating your like chocolate croissant from Starbucks, like normal morning.
It would take an extreme move for me to even give a shit, like, to be honest. It would have to be all over 10 million to trade.
Yeah. It almost seems like a bigger driver for you would just be like more of updates on the fund. Like, are you getting funding, or is this like more of like, I know it's obviously all business related, but I'm not saying the trading within the business, other external business factors.
The biggest stress in this business is managing and dealing with drawdown, which is inevitable for any legitimate hedge fund and legitimate trader. It's going to happen. There have been years where I had no drawdown, like virtually none, which is amazing. And you're just like so thankful. But then there are years I've come out of the gate getting absolutely hammered. And you got to claw your way back. You got to trust your work and your process. And you got to put on more risk sometime than you want to get out of the hole. And that is the toughest part of this business that breaks people. That really is. And especially whenever you're dealing with like real money from other people. And like for me, with my investors and my clients, it's humiliating to be down. Because you're supposed to be an expert, and being able to not beat yourself up and lose confidence in your work and program and process and be true to your fiduciary mandate is the most difficult part of managing your own and your investors' expectations.
That makes sense. Now, I would assume they get harder. It gets more difficult, if you will, as things scale. But speaking of scaling, like, we're talking about your fund, and then also here in New York, I could like be reading about, I don't know, a random bank that has like trillions of dollars, or Goldman recently had a bad quarter because of their bond trading, which I think was billions of dollars. So is the goal for you to scale as big as possible, or is there a mathematical, theoretical sweet spot for you? You're like, if I could get to this, that's where I want to be, no bigger, no smaller type of a thing?
Yeah, so I want to trade energy predominantly in my first fund. And there's a number for that. It is relatively high, but it would be considered a mid-level hedge fund, nothing crazy.
Okay.
I'm staying in the mid-level hedge fund AUM range. I like to be nimble. I don't want to move markets or even attract any attention in that regard. So, because when you get so big like Citadel or Bridgewater, it becomes political at that point. I mean, you are part of the market in the economy. I have no interest in that. So
gotcha.
I would probably, if like you gave me a number to throw here, 500 million to $1 billion to trade 15% margin equity ratio, I'd be more than happy with and cap it out.
And at that size, that doesn't move markets? That would not move the crude oil market?
No, it would not. Because you're really only trading 150 or $200 million worth of futures at $1 billion to be within safe risk parameters. And I mean, there's trillions of dollars of crude oil globally traded. So you're not really, I mean, like on a physical level, you know what I mean? So you're not, even if paper, it's less. But I mean, you have 500,000 contracts on the NYMEX prompt month a day being traded, and that's not even ICE.
Gotcha.
So you're not going to really do much damage there.
I'm just cracking up because I feel like, not from a social aspect, but just from like almost like a negative Nancy, you must be like not fun at all to bring to Vegas, because you're going to be sitting down at the games and be like, no, we shouldn't play blackjack because they have an edge at 2 points.
I only play roulette.
Really, really? But doesn't the house still have the edge in that? I was just playing it the other, isn't it like 2 to 3%?
You need to know how to bet and when to bet in roulette and know why.
So is it like, not so we don't go too far off the rails, are you more of like the martingale? Like if black comes up 5 times in a row, you start betting red just because of like the odds start to favor you over that series?
Yep, pretty much.
Interesting. So a man of roulette. I like that. All right. So anyway, back to the main thing here. For the people listening, they're like, okay, I get it. I want to try out systematic trading. I want to try out quantitative trading. Are there certain books you would recommend, certain websites? Like the average person who maybe has a little bit of this mathematical capability, what is your advice for them to actually get started?
There's five books I would recommend. Perry Kaufman's New Trading Systems and Methods, Robert Crover's three books, and Robert Pardo's Analysis and Optimization of Systematic Trading Strategies.
Okay, I will make sure to put those all in the description, everyone listening, so you can just look there. I do appreciate that. And now just moving on a little bit. So obviously it sounds like you are much more reactive to recent mathematical patterns within the market. But even then, I'm sure you're taking in the news day over day. Do you have thoughts on the oil market right now? Do you have thoughts on the overall market right now? Or is that really, you're like, I'm not in the game of predicting?
I can almost guarantee with a lot of certainty from my own analysis that we're going to view the overall index markets probably being range bound for quite some time. You're going to have this 4,500 level to 3,500 level, maybe lows of 3,000, maybe highs of 4,800. But I mean, we're going to be range bound, and in my opinion, for a very long time. So
long time. Well, retail, to retail, that could be a couple weeks, but it sounds like you're talking about potentially in excess of a year.
Yeah, probably years.
Okay.
I think there's a chance you get a big crash or we're range bound indefinitely. I don't think we're going to see a continued bull market higher and higher and higher and break new highs. Not for a while.
Well, so, what about the energy market? Recently, I've been reading about OPEC. They did a cut, so oil went up, but it seems like all year natural gas is doing nothing but vomiting. Do you have predictions for people thinking about like when they should be, I don't know, filling up their oil tanks or something like that?
I mean, I'm a signal-based guy, and my data, my work tracks the data, so I can't really give you any real macro perspective because of commodities. It's so supply and demand relevant, whereas the equity markets are a lot more macro and part of the infrastructure of the world now. They're not really independent on supply and demand. Okay. So it's two different animals. One reason why I went to commodity trading is to get away from the Federal Reserve's influence in the markets, which is so unbelievably prevalent now. Mm-hmm. I mean, I was considered an alarmist in 2014 and 15 about the Fed's involvement. People said it was crazy. The Fed isn't manipulating or moving markets. And now it's a known fact. So what's going to end up happening next is, unless the Fed can continue to do so, and unless we can build more market cap for individual companies to prop up the indexes, you're going to have stagnation or a sell-off of de-risking and deleveraging. So there's not really much of a bull thesis. So I don't really see equity markets going much higher. And for commodity markets, it's going to come down to geopolitical events. What's going to happen if China and Taiwan? What's going to happen if the situation in Europe and Russia? Are things going to get worse globally of war, upheaval, whatever? That is going to depend on these different nations making their decisions on how they're going to interact with each other, which I think will ultimately be what creates larger sigma moves for commodities.
Gotcha.
We're just going to be in a normal market where geopolitical tensions calm down and we're more fundamentally driven, and those numbers will come out and we'll pick a direction. But,
with it's funny that you said alarmist 2014 with the Fed, because right now I feel like almost from a populist movement standpoint, that's one of the popularities of Bitcoin, of like somehow storing value outside of the world of monetary policy, especially in a forever expanding credit system. Do you have any personal thoughts on crypto? Do you like it? Do you think it's a sham? Where are you at on that?
I was a big advocate of crypto being an outrageous side effect of 12 years of Federal Reserve policy that was reckless. Okay. And I advised Alex and our people last year at the peak to get out of it. And I'm not surprised that it crashed. I don't think it's a safe haven. I think it has good merit. I think it's trying to do well. But I think the real safe haven is being able to build legitimate systematic trading strategies to trade directional movement and volatility in commodities, equities, indexes. That's your real, I can live through any market scenario and make money without having to be exposed to gold or indexes or crypto or bonds. I mean, all you're really doing in that situation is trying to find a place to hide. So in a way, you're timing anyways, right?
Yeah, no, definitely. Well, what about to someone, let's just say you were talking to like a grandparent out there. They don't really necessarily have time to work on these strategies or something like that. For them in this environment, would you just be like, hey, you're going to get a 5% yield from bonds? Like, is that where you would... Okay, so you're going to do like a bond laddering type of a thing, and because like the yields are nice right now.
I would recommend for the time being, for the next 18 months, liquidating real estate, liquidating equity exposure, and putting the majority of your money in cash and T-bills. Can't trade. That would be my recommendation on what to do until we can see how the Federal Reserve is going to handle the entire situation, the economy, inflation, until we can see some geopolitical tensions calm down or not.
Yeah, no, that's completely fair. And I still, I'm thinking about what you're saying, and I like that the way you put it. Of regardless of what happens, the best hedge is you having systems that can go both ways and handle these events, whether things are quote unquote good as in bullish, quote unquote bad of bearish. For you, it sounds like the only thing you don't like is chop. Like it sounds like little short-term chop is worse, but as long as you're trending, it sounds like you're pretty indifferent.
Sideways markets and chop are what obliterate me.
So that's all you care about. Man, I like it. I like it. Is there anything that you just want to leave with the listeners to this right now? Maybe a couple next steps or anything on your mind that you want to clarify?
Reading is paramount. The books that I recommend are beginner level books. They need to be read and retained. And it's going to be a long road if you want to do this appropriately. And it's not for the faint of heart. It's a tough business and requires strong psychological discipline and emotional discipline. If you are somebody who cannot do that, you will just waste your time and money.
Man, I think that's a perfect way to end it. I truly appreciate your time. And as things develop, I hope we bring you back on the show again in the future. But once again, from me, the audience, thank you for your time and your insights.
Thank you.
Have a good one.